last week we had maybe one of the craziest earnings seasons I have seen. We have seen some of the largest companies, the tech companies, some were up 10-15% after the reporting, some were down 25-30%. Billions were lost in market cap and gained. What did you see in those results, and why do you think investors reacted like that?
Yeah, it was a pretty crazy earnings season, and especially on reporting days, names moved 15-20%. And I think there's a couple of things going on here on the very short side, or short term. And we are long-term investors, but still, obviously, we tap into what's going on quarterly basis to see if those long-term trends are intact. So there's a couple of things there. First, very high level. So interest rates are moving up rapidly, so everyone's nervous. And that's been taking down some of the high multiple names. And if those names, when they report earnings, come in with weaker results, then they're absolutely slaughtered. So that's when you see 10, 15, 20% down. And then you have an interesting thing in the market. I think it's worth mentioning that more than 50% of assets in many asset classes now are passive investments. So if a name falls, then that passive investor needs to sell more. That algorithm needs to sell more. So it feeds this volatility. And that's something that's a little bit new. So we're seeing a decline in markets, and then passive being a large portion of that. And it's actually kind of interesting because passive isn't necessarily passive. They're actively selling in the market. But us as active investors are actually not selling, actually not buying at all. We are looking at those long-term trends. So you have that aspect as well. And then if you look at the individual names, you have some names that are clearly COVID winners, like Zoom, like Peloton, the exercise bike, and they've been slaughtered in this market because it seems like people were really paying up for those names and buying the products in a COVID setting. And now as COVID and Omicron wanes and disappears, hopefully, those names will not grow as fast. So there's a reason why those names are down a lot. And then you have high multiple names. It goes to this, rates are moving up. So long duration assets where a lot of the earnings are coming in future periods down the road, basically, they also decline. And then there's some specifics here. So for instance, in the area of social media, like Meta or Facebook, they reported their first decline in daily active users. And we've never seen that on a quarterly basis before. And that's because of increased competition from other social media networks and I guess also other ways of spending your time. So that's why that name, Meta or Facebook, was down 20+% when they reported. Also taking down all the other social media names with it. And then there's names that actually performed quite well that are up quite a lot when they report. So you had Google, I think it was up 10-ish%, and then you had Amazon up 13%, and you also had Microsoft up some 5-6%. And Microsoft is also interesting because it was down 7% in the aftermarket just after reporting. People were disappointed with growth in their cloud business. And then 2 hours and 5 minutes later, they came out and guided for the next quarter and say growth is going to accelerate, and it was up 5 or 6%. So 13% move in 2 hours, $280 billion move. So also kind of a crazy move. But all those three names have been moving in the right direction, and we own all of them.
And it seems like cloud is the one winning, you know, the cloud space. If you should find something in those three companies and other companies we have seen. So that is, cloud is the winning factor. There we can talk about accelerating growth. Why is that actually?
Yeah, it's kind of back to what we talked about last time. It's pricing power and it's growth. So if you look at some of these names, they are growing 40+%. So Amazon with Amazon Web Services is growing 39.5%, so 40%. And then you have Microsoft growing 46% and Google growing 45% in their cloud business. So massive growth, also in some cases accelerating growth, and they can charge a lot for these services because we need cloud services. Everyone needs that. You need it when you save a photo. It's not on your phone, it's in a cloud. This company needs it when we save an Excel spreadsheet, it's in Microsoft's cloud. And the data and explosion in data means that this is just likely to continue. So this quarter, it's basically been for us to tap into those names and see, yeah, the long-term thesis that cloud is going to be a massive 10-year trend is intact. And then just check the boxes. It seems like it's going on in this quarter as well. We don't necessarily have a view on each quarter, but certainly this quarter, it was evident that the trend seems to be intact.
And looking at the cloud space, you mentioned you own those shares, but I also see in the software as a service sector with the high multiple names, you haven't avoided at least a pressure on some of the names, even if the underlying factors. So are you also experienced that in some of your investment, and does that change any of your view? Were they too high priced, or if you think the cloud has a long period of high growth, it doesn't matter for you?
Yeah, we had one name that has underperformed, so that's Adobe. So that's a cloud name in the sense that they're selling cloud services as software as a service. So you can log in and use their editing software, for instance, and that's managed by Adobe on the cloud. And that's a high multiple stock that's come down. They guided in December already a little bit weaker than people expected. But actually, if you look into the details of that guidance, and there's some adjustments for an extra week last year, acquisition and FX, they're basically guiding for 2022 as they guided for 2021, and they had an amazing 2021. So we're not worried at all about the long-term outlook for Adobe. It's come down, high multiple, but it looks very, very attractive. And the long-term trends that we see with, for instance, influencers needing to use their software. We use their software all the time, and the metaverse could be another driver for them, that we need to produce content, and that's what they're all about. The long-term drivers are intact. Guidance looks as strong as last year, and perhaps somewhat clouded by short-term factors. But it's come down and looks really attractive.
So if you should come with a general rule, technology is not technology as a headline, you are primarily exposing yourself to the technology sector through the cloud. Is that correct? And do you think that's some of the best advice people can get right now, both short-term and long-term?
Yeah, everyone's been talking about FANG. So Facebook and Netflix is obviously part of that. And that's names that clearly underperformed this quarter. But I think it's more important to truly be stock pickers and pick out the names that you actually like, and not say just own technology. Within technology, there's challenge spaces. There are names that are too expensive. You have, I wouldn't say fads, but a Peloton, for instance, looks like it's a fad. Everyone bought one of these bikes in the US, now no one's buying them. So it's important not just to say, let's buy technology. It's important to be a stock picker and try to pick out the names that you like. And for instance, one thing that we do like is cloud growth. We own the cloud names and they have performed.